And gold's the larger asset by a factor of about 10. A lot of the biggest pools of capital still understand it better than Bitcoin. Bitcoin's viewed more as like a tech play, something that is to do homework on to figure out. Whereas gold is, been around for a while. I sometimes I get a little concerned around Bitcoin getting ahead of its skis. Other times I get a little concerned around gold getting ahead of its skis. Right now, gold, just by more metrics, is kind of sentiment overbought. Even though I still think the long-term case for it is good. But over the next 6-12 months, I'd put my vote for Bitcoin. I think that kind of that rotation, and I could be wrong in this. Maybe we look back 6-12 months from now and maybe gold still outperformed again. But my guess would be Bitcoin is probably going to take over.
Markets often reward balance over blind conviction. That's the lens macro analyst Lyn Alden brings when looking at Bitcoin and gold. She believes Bitcoin generally outperforms, but she rejects the straight-to-the-moon narrative. Cycles matter, and history shows each asset has seasons of strength. Holding both gives investors coverage when one side lags. Alden notes that Bitcoin needed the recent shakeout in overheated treasury companies and speculative players. That correction cleared excess leverage and weak hands, leaving the market on firmer footing. With the Fed leaning slightly more dovish, unlevered, custodial Bitcoin looks especially attractive. It's a cleaner way to participate in upside without unnecessary risks. Among public companies, Alden points to MicroStrategy in the US and Metaplanet in Japan as the leaders. Both dominate liquidity in their respective markets, which gives them structural advantages. Smaller firms, she says, face steeper challenges unless they bring additional value like steady cash flows to offset risk. On gold, Alden remains bullish long-term but sees signs of froth after the recent sharp run-up. That doesn't negate the case for owning it, but it does mean near-term caution makes sense. Beyond precious metals, she's watching emerging markets, which still appear early in their cycle and could offer meaningful opportunities. For Alden, diversification across hard assets and regions isn't about hedging fear, it's about staying positioned for the next phase of global capital flows. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Part of why I've not been that disappointed is because I've been more in I sometimes describe myself as like a bearish bull.
Yeah.
On Bitcoin, I try to always have conservative bullish targets,
Sure.
which is that it's like I'm always like I think it's going to outperform things, but I don't think it's going to the moon anytime soon. And we can talk about why that is, but part of the reason I like to hold both is because they don't always perform well at the same time. Sometimes Bitcoin gets ahead of itself, sometimes gold gets ahead of itself.
Right now it's gold.
Yeah, gold's the larger asset by a factor of about 10. A lot of the biggest pools of capital still understand it better than Bitcoin. Bitcoin's viewed more as like a tech play, something that is to do homework on to figure out. Whereas gold is, been around for a while. I sometimes I get a little concerned around Bitcoin getting ahead of its skis. Other times I get a little concerned around gold getting ahead of its skis. Right now, gold, just by more metrics, is kind of sentiment overbought. Even though I still think the long-term case for it is good. But over the next 6-12 months, I'd put my vote for Bitcoin. I think that kind of that rotation, and I could be wrong in this. Maybe we look back 6-12 months from now and maybe gold still outperformed again. But my guess would be Bitcoin is probably going to take over for a while. I think partially we had to see some of the MNAVs, like overvalued MNAVs of treasury companies, deflate to some extent. Once we saw like altcoin treasury companies coming to market, basically at that point, you just kind of have to expect there's going to be a washout to kind of get the kind of tourists out of the system, both in Bitcoin and around Bitcoin. But then that allows for a platform to rebuild from. And now that we see the Fed getting a little bit more dovish, we've seen some of that kind of already get washed out. I think Bitcoin's in a better place for the next 6-12 months. Going forward would be my base case. Yeah, and I think it's a new industry, so it makes sense. Many of them do have elements that are speculative. The only one that I've ever owned is MicroStrategy. I would own Metaplanet in certain valuations. So I've been watching that one now that it's come down. I think that one's very well managed. I think those are kind of the two cream of the crop that are out there. I think what makes a good one is that you generally want to be the liquidity leader in your market. So in the US, that's MicroStrategy. In Japan, that's Metaplanet. There are other opportunities for other big capital markets as well. I think the market's made it clear that if one is unprofitable, they tend to put a pretty big discount on that, just because they view it as a liability to the longer term Bitcoin strategy. In addition, if you're the third, fourth, fifth, sixth most liquid one at what you're doing, it's just challenging. Now, that's where they can add differentiation. If one has cash flows, they can kind of market that and say we're a hybrid entity. We have this other business that's not Bitcoin, and so you can kind of put the two together and they can balance out each other's risk. So they have to kind of explore what's going to work for the market. But I do think it's healthy that a lot of this was washed out, just because whenever something starts to look like free money, that's when more entities are going to come in. That's when you're going to get, like I said, there were like altcoin treasury companies coming to market. It kind of needed a reset. I still think the model makes sense, which is, and there's a couple of different models here. One is the pure play. I think that one, it really helps to be a leader in your market, kind of the one of the top two or so. But then there's a long tail of just any company, if they want, if you're selling, whatever the case may be, to have Bitcoin on your balance sheet and make some sense of that. So I think that's still a long-term strategy, and I think that we're in a healthier spot now that some of this has been kind of the froth has been reduced. I think Bitcoin's in a good space for the next 12 months. I think we've seen a decent amount of washout. So just unlevered self-custodial Bitcoin is, I think, in a great space right now. Some of the better treasury companies that are either cash flow neutral or positive and their MNAVs have come down a lot. I think that's been somewhat de-risked, especially if they're the ones that also have pretty low leverage. I think those are in decent shape. Gold I like longer term, but the value investor in me is a little bit, it came up pretty high pretty fast.
Yeah.
I started warning about that back in April, and it did this pretty long consolidation. It recently just broke out of it. So I got a little bit more kind of bullish again, but it's still just a little frothy. We'll see.
Okay.
I've been, emerging markets are one of the areas that, I've actually kind of liked, or at least select emerging markets. It was kind of off people's radar. But it's something that, I've been pretty bullish on, and I still kind of continue to be probably for the next 12 months or so. I still think there's kind of room in the cycle for that. But I do think that probably unlevered Bitcoin is in a pretty good space right now.
Lyn Alden points out that governments clearly recognize the importance of regulating stablecoins, but the banking sector feels threatened by them. Stablecoins compete directly with traditional deposits. A fully backed stablecoin, in many ways, looks safer than a fractional reserve bank account. That raises an uncomfortable question. Why would savers leave money in banks if a better and more transparent option is available? This is why regulators often block stablecoin issuers from offering interest payments. If they were allowed, the migration out of banks could accelerate. Alden also highlights how difficult the stablecoin business is to enter. Network effects give early leaders a massive advantage, much like the way large banks enjoy access to the cheapest deposits. The top 1 or 2 issuers end up capturing most of the market, which translates into extraordinary profits. In fact, some stablecoin issuers generate among the highest revenue per employee of any company today. But Alden believes that edge is temporary. As regulations evolve and new competitors enter the space, margins are likely to shrink. Citi projects that stablecoin demand could reach between $1 and $3 trillion by 2030. While that sounds large, Alden reminds us it remains small compared to annual U.S. deficits of roughly $2 trillion. Let's get back to the interview.
I think that as stablecoins were already growing pretty rapidly, and as there's pretty clear demand for them, it made sense for them to try to bring them into the fold. So 5+ years ago, stablecoins were very small. They were kind of on the periphery. But now, there's individual stablecoins that have, well over 100 billion, and collectively it's a multi-$100 billion industry. I think it could clear on its way to, $1 trillion in AUM eventually. These are really big pools of capital. It's basically the modern euro dollar. So offshore dollars is kind of the biggest use case for them. But of course, you can bring some of them onshore for certain purposes too. Anyone who sent an international wire can potentially see the benefit of stablecoins and how efficient they can be. And of course, people that want dollars in jurisdictions where it's harder to get physical dollars, it's also obviously a pretty powerful use case. So I do think it makes sense for the government to want to codify how they work. Naturally, banks get spooked by them because so they try to make it so that stablecoins can't directly pay yield and things like that, so that they don't compete too much with bank deposits. There's been a long history of whether it's central bankers, whether it's the government, kind of being fearful of kind of full reserve looking things.
Yeah, that's right.
So because they worry that if something is full reserve and something fractional reserve, what happens to the fractional reserve one? Why wouldn't all the capital just suck out?
Exactly.
And then what does that do to the entire current lending dynamic that has all the existing stakeholders that like it the way it is? As long as, they're hard to get because there's liquidity network effects in play. So it's easier to start a bank than it is to start a stablecoin. So it kind of rewards the earliest movers that got through things and are now the top 1, 2, potentially 3 stablecoin issuers. But for those that can get to that point, it's quite lucrative. Another way of putting it is that the really big banks in the country, they can have they have a pretty big deposit base of like near zero yielding deposits, whereas a lot of smaller banks struggle to retain their deposits and they have to pay a higher rate. So stablecoins right now are able to pay even before certain laws kind of make it harder to pay yield. Just clearly there's been enough demand for them without them passing on any of that yield. And because there's fairly few issuers that have any sort of network effect to speak of, it's been extraordinarily profitable, like kind of up there in like the most profit you can get per employee. I think that's, to some extent, that's an anomaly of the era we're in now, that just early mover arbitrage, this happens, and then eventually kind of other entities can kind of take their cut over time. But it is clearly a very profitable space. I tend to downplay the idea that stablecoins are going to like fix US debt, basically. I think that a common thing we see is people always want clean answers for how we're going to get out that don't involve pain. So then it's like, well, stablecoins is this new thing we can point to. And there was a report by Citi, maybe 6 months ago. I don't know the exact date that it came out, but like the Treasury Secretary referred to it as well. And if you dig into what they covered, they kind of had a bear, base, and bull case for how much stablecoins there could be by, I believe, 2030. And their base case was over $1 trillion in new stablecoin demand. Their bull case was over $3 trillion. But a lot of that was from existing pools of capital that already like dollars. So that basically represents, say, taking out of money markets or taking out of banks and putting it in stablecoins. And yet part of that thing that they were holding before was already holding treasuries. So it kind of shifts where you hold treasuries. Wholesale, entirely new demand for dollars and treasuries, while present in that report and similar analysis, is only a fraction of the headline number that you see. I certainly think that stablecoins can add billions and over time tens or hundreds of billions of new treasury demand. But when we're talking 2 trillion in new deficits per year, so basically new treasury supply per year, that is just one variable among many. It's not some sort of saving grace for the whole fiscal environment. I think that any entity that is large enough, will investigate issuing a stablecoin. Some will try. I think the challenge again is there's network effects at play. And then the question is their stablecoin kind of scaling above their own ecosystem? So for example, if an entity just replaces some of its own deposits with stablecoin or stablecoin-like things, that's not the same thing as basically having stablecoin, issuing it, and collecting a lot of new AUM, a lot of new assets under management because your stablecoin has taken off. And it's kind of, it goes back to the kind of the whole point of what money is and why stablecoins, at least kind of to currently work as money or money-like assets, is because there's not that many of them. When people, potentially want to pay in stablecoins, it's like, instead of saying which of the 37 stablecoins are we going to pick from, it's kind of known which one or two you're going to use. and so it's kind of synonymous with the thing that it's underlying the dollar.
Yeah.
So I do think that we'll see somewhat of a scramble for kind of stablecoin participation. But ultimately, I think that monetary network effects settle closer to one.
Power is shifting in global markets. Digital money is no longer just a side experiment. Gold is reasserting its role as a store of value, and stablecoins are exposing weaknesses in the traditional banking model. Investors are beginning to spread their bets, not because of fear, but because the flow of capital is telling them the old system is losing its grip. What was once dominated by central banks and bond markets is now being tested by transparent, borderless alternatives. The real issue is whether the next decade belongs to institutions that cling to yesterday's tools, or to those that adapt early to this new mix of assets. So the question becomes, which pillar of finance will define the next chapter? Banks, blockchains, or bullion? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the daily updates. Thank you for the support, and I hope you enjoy the video.